Welcome back to AI Research. Today we are analyzing the M2 money supply. This chart shows the M2 money supply in the United States from approximately 1960 through early 2025, sourced from the Federal Reserve Bank of St. Louis, Fed. M2 is a critical metric because it measures the total amount of money in circulation, including cash, checking deposits, and near money, like savings and money market securities. Key historical observations. The 2020 parabolic spike. The most striking feature of the graph is the vertical surge starting in 2020. This represents the unprecedented fiscal and monetary response to the COVID-19 pandemic, where the supply jumped from roughly $15 trillion to over $21 trillion in a very short window. Historical long-term growth. Before 2020, the money supply followed a steady exponential path. While the 2008 financial crisis caused a visible step up due to the start of quantitative easing, QE, it pales in comparison to the recent era. Recessions, shaded areas. The gray vertical bars indicate U.S. recessions. Historically, the money supply almost always increases during these times as the Fed injects liquidity to stimulate the economy. Why did M2 drop in 2022-2023 and then rise again into 2025? The movement you see, the first major dip in modern history followed by a 2024-2025 recovery, marks a rare, monetary cycle. 1. The 2022-2023 drop, the Great Drain. For the first time since the 1930s, the money supply actually contracted. This was a deliberate pulling back of money by the Federal Reserve to fight high inflation. Quantitative tightening, QT. The Fed shrank its balance sheet by letting bonds expire, effectively deleting money from the system. Interest rate hikes. By raising rates to over 5%, borrowing became expensive. In our banking system, fewer loans mean less new money is created. 2. The 2024-2025 rise, normalization and the pivot. The rebound toward the end of the chart shows the economy returning to its long-term growth trend. The pivot to rate cuts. Starting in late 2024, the Fed began cutting interest rates. Lower rates encourage bank lending, which naturally expands the money supply. Record money market inflows. High interest rates incentivized people to move cash into money market funds. Since these are included in M2, the total supply hit new all-time highs of over $22.3 trillion by early 2025. End of contraction. By 2025, the Fed signaled an end to aggressive tightening to ensure the banking system remained liquid, allowing the M2 supply to stabilize and grow alongside the GDP. What this means for the economy. The massive 2020 spike acted as the primary driver for the inflation of 2021 to 2023. While the 2022 dip was a historic attempt to cool off the economy, the current rise into 2025 suggests that the extra money from the pandemic era is now a permanent part of the price floor. We are moving out of a period of contraction and back into a period of steady monetary expansion. Alright, this is the AI Research. If you find any value in this, subscribe for more. See you in the next video.